Phil, does any of the game plan change if bond bears come back? And what if it's with a vengeance?
In my view, I don't think that's going to happen. I think ultimately, stocks will prevail this year. I think that the Fed and the volatility around what the Fed's going to be doing, which is really key to understanding where markets are going. And I think ultimately the Fed is going to cut rates as the market expected, especially in the beginning of the year and even now. And that's, I think we're seeing a lot of volatility and we're starting to see interest rates move on the higher end, on the longer end rather, simply because the economy is robust. When the economy is robust, you see the long end really perform well. Alan Greenspan said it all the time that, tell me where the 10-year is and I'll tell you where the economy is going. So where's the 10-year going? The 10-year has been rising and the economy obviously has been robust. So that's the volatility that we're seeing in the markets overall. And that's some of the pressure in the bond market we're seeing as well.
There's a distinction here between thinking that bonds aren't going to sell off too hard versus stocks will be fine if they do. It sounds like you're kind of more in the camp that you don't think bonds are going to be a problem again because of the potential for them to kind of crash like they did. You just don't see that happening? Or is the point that even if they do, we've got all this AI growth to propel us beyond whatever problems the yield will bring?
Yes, what we saw in 22 and 23 was such an anomaly. We've never ever seen that in the bond market in terms of the move that we've seen. So we're not going to see that, and that's not going to be repeated that this year. What we're going to see is, and what we're seeing is really rates normalize. We saw the 10-year hit a 5 handle, then came down, below four, and now we're rallying, almost half of the down move that we've seen. And again, just realize that the economy is really robust right now. The Fed hasn't cut rates and the economy still remains resilient. So with that, again, if you have earnings that are going to accelerate, you got a Fed that's going to cut, that's going to be very good for stocks overall. And, there are probably other parts of the economy, such as commercial real estate, that may still be affected by the Fed holding where he's at. But even with the Fed holding where he's at and as good as we're performing, I feel pretty good about both stocks and bonds this year.
Okay. Within stocks, what's the best way to, I guess, insulate yourself? Do you go for hyper growth? Is that the best way to escape any drag that bonds might bring? Or does that bring you to expensive stocks that are sensitive to changes in interest rates? How do you balance that?
Yeah, so we don't believe in forecasting and predicting where interest rates are going to go in the short term or the stock market. We really believe that's a loser's game. We opine on it, but that's not an investment strategy. We need to have fixed income in our portfolio to balance out stocks in the event we get an economic crash, right? So if you get an economic recession, then typically treasuries, both long-term and intermediate term, will rally because in that type of situation, rates actually will come down. In a situation where rates continue to move higher will only be because economy continues to be robust and resilient, but interest rates will only move up so high unless inflation continues to get out of control again, which I don't believe is going to happen. So really it's balancing your portfolio on both fronts, right? So if rates are going up, economies are doing well, probably earnings will do well, so stocks will do well. There'll be some pressure on bonds, so shorten up duration is not a bad idea in this type of environment today. But again, we personally hedge out stocks with intermediate term and long duration treasuries.
Okay. So in the meantime, unless those go nuts again, let's focus on the stocks that you do like. Palantir seems to still be a favorite in your mind. Walk me through the latest kind of case for the company.
Yeah, so I am a huge believer in this artificial intelligence, as so many people are as well. And I believe we're in the second or third inning of this, and it's something of the internet is what we're going to see. And there are going to be certain companies that are going to be on the forefront and others that are not. Palantir seems to be showing their strength with their AI machine learning platform, both Foundry and Gotham. And we saw it with the win with the Army contract of the Titan program, which is a $178 million win over a 2-year contract. Now, my belief is they're going to be able to show their strength and the performance of their platform, and the Army will continue to do business well beyond 2 years and actually increase the amount to do business in. So that was a big win for the stock. One of the reasons why we saw the stock perform well during their earnings. The second part, it's really about the free cash flow. Their free cash flow went from negative 11.3%, that's the free cash flow margin percentage of revenue, to now forecasted and is greater than 20%. I mean, that's a tremendous move and shows you that there are, and this is what's most interesting to me, is that on the commercial side of things, commercial customers are early adopters of their AI technology. which is what we don't normally see that in the commercial industry. But we're seeing that today because commercial companies recognize the value of AI to their businesses to increase productivity, and Palantir is the winner of that.
So they're going to have a nice balance. They've got their steady government-driven cash flows, and now if they can kind of get a little bit more consumer-centric and facing, which they have made efforts to over the years, then kind of get a bonus on it. Shares been hanging out near $20. We're going to look at some trading here, and then I'm going to come back to you, Phil, because you got a very different pick, too, that you like. But let's look at the trade here, Tom, for Palantir while we're on it. It's been hanging out range-bound, basically, since its earnings rally.
Yeah, but if you look over the last, 12 months, it's up about 170%.
Yeah.
So it's made some inroads. And if you think it's going to continue to move higher, I looked at an option strategy. It doesn't pay a dividend, so I looked at an option strategy. If you want to buy the shares, you can do that. But I looked with some duration at this option strategy where I went out to the August monthly cycle, so about 135 days till expiration. And I looked at buying an at-the-money call, the 22 strike call, but to offset some of the costs on that long call because it's got a lot of extrinsic option premium in there, I looked at selling the 30 strike call against it, so creating a bullish $8 wide call vertical to the upside over the next 4 months. You're paying roughly about a $240 debit for that. That's going to be make your break even about $240 or $24.40. That's only about 9% above the current share price. And now, why do you sell the 30 strike call against the long 22? Why don't you just buy the 22 call? Well, it's going to cost you more, right? Because you're not offsetting some of the costs.
We also haven't been above 30 yet. Seems like it's kind of a wall there.
30, that 29.5 level is about resistance over the last couple of years. So that's why I picked that strike. And plus, if you think the stock's going to go higher or, up more than 34% to the $30 level, then just buy the 22 call. But this way, you're kind of offsetting some of the costs. You don't have as much at risk. The debit you pay is your risk on this trade, but you're giving yourself plenty of duration. You're going to capture an earnings event in there also.
Okay, nice. All right, so you get it through the next earnings, and you don't need it to do anything fancy, really. Right. You just kind of need it to hang out, rally a little bit more. $30, to your point, was a wall a couple of years ago, too. So I like the idea of selling the strike above there. Flipping to a different type of stock here and a very different performer. Phil, real quick, give me the 60-second pitch for Starbucks down at 52-week lows.
Greatest brands, I think, in the world. Their guidance is 15 to 20% growth over the next really year or 2 years. Their return on investment capital is 30% plus. The key thing for Starbucks, really is their $1 billion savings goal for the end of this year and going into next year, which I believe they'll achieve. I think they could widen out margins by about 360 basis points by 2026. Restaurant traffic overall is down, and top-line growth for restaurant industry is about 4%. Starbucks anticipated to be 8%. They're going to continue to win market share. They just do a great job overall. They're renovating their stores. They're always renovating. They're always increasing their food and their beverage. And they're investing a lot in their digital platform and winning loyalty members. So overall, Starbucks stock is down because of traffic issues and slow increase in pricing, which is very much the same across all restaurant businesses. So there's nothing new there. Overall, Starbucks is a great business. It's a healthy financial business, most importantly, and the anticipated growth going forward is also very healthy.
All right. Okay, so viewing it as a true staple, it sounds like is one way you describe it. Appreciate your time, Phil. Thanks.